Happy New Year, everyone. Our Classroom Stock portfolio of high-yield, dividend-paying companies now has an annual return of 23.33%, and it's beating the S&P 500 since the portfolio started. And our Dividend-Growth portfolio, which was started 20 months earlier, has an annual return of 17.88%. Since our last video, both dividend portfolios beat the S&P 500, but its true benchmark is the ETF with the ticker symbol SCHD, which we discussed later in the video. But our best performing portfolio so far has been our technology portfolio, which has an annualized return of 34.37%. It has only been in existence since April of last year, so its return will likely fluctuate a lot, and it's very volatile. Later in the video, I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. But depending on how much diversification you require, that might be relatively easy to do, as our Dividend-Growth stock portfolio currently has 105 holdings, our high-yield stock portfolio has 32 holdings, and our tech stock portfolio has 24 holdings. So what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $2,676 after 157 weeks. Each week, we take that deposit and split it up to buy 10 different dividend-paying stocks, so we are buying fractional shares of stock. Each week, we re-rate the stocks, so the list of top stocks fluctuates from week to week. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. The tan line on the chart shows what the portfolio value would be if we had instead put the money into a simple savings account. In our first year, 2022, stocks didn't do well, and as you can see, where our portfolio has had overall losses, where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023. I'll also update our tech stock portfolio later in this video, which has only existed since April of last year, but has been the best performing portfolio over that time. And for those that have been asking, I put the dividend growth stock portfolio and the high yield stock portfolio, and as of the Christmas break, the tech stock portfolio on our website, which is beatthestockmarket.com. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use accounting concepts that I teach to pick stocks because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action starting in 2022, we started a class project in which each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 a month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you want to just jump to the list of stocks we bought last week, or the list of our best performers, or any other section of the video. So what happened since our last video in the markets? Well, there was a lot of profit taking, except for on Friday when the S&P 500 jumped 1.26%. Now next week we get two jobs reports, with the most important one coming out on Friday, that being the non-farms payroll report. That could very well give us better indication of future Federal Reserve interest rate cuts, or worst case scenario, even interest rate hikes. Not likely, but you never know. Remember that on Thursday, the market will be closed to honor the passing of President Jimmy Carter. And on January 15th, large banks like JP Morgan kick off the fourth quarter earnings season. So we should start seeing more changes in our stock rankings as the company reports roll in. Now, the Center for Financial Research and Analysis estimates that the earnings per share, EPS, for the 500 S&P 500 companies will have increased 8.5% in 2024 once those reports come in. Now that led the S&P 500 to jump 23.3% last year. So how much will the earnings per share for the S&P 500 increase in 2025? Well, the Center for Financial Research and Analysis estimates that it will jump 12.8%, a 50.6% jump over last year. If that estimate is accurate, we should see a lot of dividend increases for our stocks this year. Now, before we get into which stocks we bought this week, a lot of people have been asking me for my favorite books about investing. My two favorite books were the basis for the 3 stock screens I publish monthly on our website, which you can see on this slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed $6.4 billion of investments when he retired. The book is the basis for two of the three stock screens I publish on our website. They are the Trending Value stock screen for those of you that are value investors, and Consumer Staple stock screens for investors that are very conservative. I update the stock screens monthly. So what's a stock screen? It's a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can invest in or do further analysis of them. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the price to earnings ratio, also called the PE ratio, dividend yield, etc., as well as combinations of those simple metrics. There are a lot of tables and graphs, so if you're a numbers geek like me, you will probably like it. It also talks about the history of the stock market and the psychology of investing, which is also fascinating and can't be overstated how important that is. The other book I recommend, especially for younger investors, was written by the son of the author that I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screen on your own. It's a much shorter book than What Works on Wall Street. I have put 2 links to the books in the description of the video for you to check out. You can also see if they're at your local library. Save yourself some money. Because we are investing additional funds each week into most of our model portfolios, the way to calculate portfolio performance becomes more complicated. The formula that is most commonly used to calculate portfolio performance is called XIRR, also known as Extended Internal Rate of Return, and we use it too. It's the same formula used to calculate portfolio performance in Quicken, the popular personal finance software. You can see the formula at the bottom of the screen. You can calculate it by hand, but if you want to maintain your sanity, you're better off using Excel to calculate for you, and then use Quicken software to double check it, which is what we do. Now in this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of the slide shows a portfolio comparison when both portfolios existed. Because remember, the dividend growth portfolio was started 20 months before the high yield portfolio. The high yield portfolio was started in August of 2023, and the annualized return so far is 23.33%, which is surprisingly higher than our dividend growth portfolio, which is an annualized return of 18.15% over the same time period, which includes way more. Now, the dividend growth portfolio includes way more growth stocks than the high yield portfolio. I expect that the dividend growth portfolio will have the higher return over the long run, especially since the high yield portfolio has less than 0.5% of the portfolio in tech stocks currently, but time will tell. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. On our website, we have ideas for technology-focused investments that provide income, ranging from dividend growth stocks to closed-end funds and ETFs. Now remember, the high yield portfolio has only existed for 60 months, so its annual return will likely jump up or down to a greater extent than our dividend growth portfolio's return. The fact that the high yield portfolio is outperforming our dividend growth portfolio over the same time period is pretty surprising to me, but we're finally seeing the difference start to narrow somewhat. Now this slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Our dividends for 2024, which just ended, increased 56% over the dividends we received in the previous year. And dividends for the latest quarter increased 43% over the same quarter a year ago. The graph shows how quickly the dividends are growing and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our 2 main portfolios? The first reason we stick with dividend-paying stocks for our dividend strategies is, according to Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year, and I'm looking forward to when it's updated, probably in the first quarter of this year. And we've included the link at the bottom of the screen. The screenshot or slide of the bottom of the slide for you to go check out. Now, Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Volatility meaning going up or down a lot. Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. Now, BlackRock recently released a report showing that $10,000 invested in companies that grow their dividends, in other words, they increase their dividends, or companies that initiated or started a dividend, grew to $2.6 million versus $1.6 million for the S&P 500, a difference of 62.5%. Now, that same $10,000 invested into only non-dividend paying stocks only grew to $1.2 million. So stocks that raised their dividends or started paying a dividend beat the stocks that did not pay dividends by 116.7%. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. So here are two examples of stocks growing their dividend payouts over the years. The first stock is Broadcom, which just increased its dividend for the second time in 2024 and for the 14th consecutive year. Now, I bought Broadcom, a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I invested in the stock, I would receive $5.01 every year. The company has quickly grown the dividend to the point where the yield, based on the original investment, is now 9.14%. And that's just 4 years later. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividend well into the future. And if not, that's why we have constructed a diversified portfolio. That's the power of investing in a quality dividend growth company. My second example of a high quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I'd invested in the stock, I would receive only 83 cents. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield based on the original investment is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, that's why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly will not find a bond that pays anywhere close to the yields on the original investment that these two stocks are paying, and bonds do not increase their payout to investors like stocks can and often do. Now, another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. This is perfect for retirees. If you're single, that amount is $63,350. Those amounts usually increase each year as the standard deduction increases and the tax brackets are adjusted, and they did increase just in November. So how are these amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in 2024. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military before I got my degree, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck into the Dividend-Growth portfolio, but found the process to be so fun that I split it up and we now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Now, another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents per week for a total of $12.09 per week instead of the original $11.74. For a classroom dividend-growth stock portfolio in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. And I had to do the calculation before Monday, so we'll have a little boost for our first contribution in 2025. Now, a very popular exchange-traded fund, ETF, that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, but no one calls it that. They always call it by the ticker symbol, SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, our dividend-growth classroom stock portfolio's annual return is 17.88%. If we'd instead invested the same exact amounts into SCHD on the same exact days, the portfolio's return would only be 8.94%, which is half our return. Now, these are annual returns. Our high-yield portfolio is also outperforming SCHD, but by an even larger amount. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD by such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting into our 2 dividend-paying classroom stock portfolios, as well as our tech stock portfolio, which we'll discuss later. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach, where no one is overseeing the stock selection. SCHD has at times had large positions in stocks I consider to be value traps, and that's not a good thing. So this slide shows our best performing stocks based on when they were initially purchased. This includes all 4 of our portfolios, but as you can see in the upper right, up here, the dividend-growth stock portfolio was started much earlier than the other portfolios, which means the stocks in that portfolio have had much more time to see their prices rise. Therefore, this list of best performing stocks thus far will be dominated by our dividend-growth stock portfolio, at least for the time being. It also has by far the most stocks in the portfolio. For example, our tech stock portfolio has been our best performing portfolio on an annual basis so far, but because it's only existed since April of last year, only one of that portfolio stocks has made the list so far, and that's Shopify at number 14 with an 86.5% total return in 7 months. Of our 2 dividend portfolios, our best performing portfolio thus far on a per year basis is the high yield portfolio, but it only has 1 stock on the list so far because the portfolio was started 20 months after the dividend growth portfolio. It also holds far fewer stocks than our dividend growth portfolio, and that stock is Tapestry at number 12 with an 89.6% total return in 13.3 months. Stocks in yellow, like Tapestry, have been sold. Our best performing stock so far has been Broadcom for our dividend growth stock portfolio. So far, it has provided our dividend growth portfolio with a 317.4% total return in less than 3 years. It was also purchased later for our tech-themed portfolio and is now 6th on our list, doubling in a year. So here it is, Broadcom, 116.1%, so it's more than doubled in 12 months. Evercore, an investment bank, is at number 2 with a 252.9% total return. It has been sold. The fastest risers that are still in the portfolio are NVIDIA in our technology theme portfolio with a total return of 200.1% in 12.1 months. Shopify, down here at number 14, 86.5% in 7 months. And Pure Storage with an 84.9% total return in 12.1 months. And the aforementioned Broadcom, which makes the list twice with 2 different portfolios at number 1 and number 6. And remember that total return includes both the dividends the company has paid as well as increase in the stock. Now, some of the tech stock portfolios like Shopify do not pay a dividend, but about 70 to 80% of the stocks in the tech stock portfolio do pay a dividend. So the non-dividend payers are rare. All right, here's the usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others on the internet, but you always need to do your own research. So, what did we sell last week? We didn't sell any stocks except for Entergy Corporation, ticker symbol ETR, in our high yield portfolio. After its recent stock split, ETR provided the portfolio with a 63.6% total return, which is 47.5% per year since it was held for 15.1 months. So why did we sell it? ETR looks to be fairly valued, and its 4-way rating, which consists of valuation, quality, past dividend growth and current yield, and future dividend growth potential. Now that 4-way rating has fallen to the bottom 32% of companies, limiting its upside potential in our eyes. Now let's talk about the dividend growth stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com last Monday, and then we purchased the top 10 stocks, not all 15, just the top 10. So we purchased the first 10 stocks that are not in the yellow highlight. So we skipped Microsoft. Why do we skip it? Because we want to maintain a diversified portfolio. So any stock that has a 4% allocation or more, we don't buy more of that stock. So instead of Microsoft, we skipped and bought Microchip. So we bought 1 through 9 plus number 11. Thermo Fisher and Lam Research both remained at the top of our rankings, but their rankings will likely start changing a lot once earnings season kicks off on January 15th. Remember, we use many criteria to filter stocks, and if a stock is hovering near a required level, the stock can make the list one week and then drop off the list based on a small movement. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. Now, for consensus earnings growth estimates, I will only purchase a stock if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. If their earnings are not increasing, they're probably not going to increase their dividends. So a stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%, which means the stock suddenly does not make the list at all. This is just one of many filtering criteria we use to narrow down our list of investable stocks. Each week we buy 10 stocks, as I mentioned, and since we're investing such a small amount each week, it means we're buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to a stock that is undervalued. This table on this slide includes a company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks last Monday appeared to be Thermo Fisher, A.O. Smith, Huntington Ingalls, NOC, and Microchip. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they are likely to continue to raise their dividends. Therefore, this is a dividend growth strategy. We did not buy any under-the-radar dividend payers last week. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stock portfolio in the next few slides and the tech stock portfolio later in the video. Last week, I purchased over $2,900 of the stocks from the dividend growth, high yield, and tech stock portfolio as I reinvest dividends and gradually transfer out of my main dividend ETF, ticker symbol SCHD, and buy these stocks instead. I'm also trying to tweak the buying strategy a bit to see if I can boost returns. I'll share the results with you once I have enough data. Now on this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. As mentioned, we did not buy any under-the-radar dividend payers last week. All the stocks we bought last week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they paid their shareholders. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of the reported earnings, also called profits. And finally, the last quality component is financial health. So if you're looking for lower risk stocks, I'd suggest looking at Nike, Microsoft, and West Pharmaceuticals. Remember that their risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings last week were Thermo Fisher, Applied Materials, Microsoft, and United Health Group. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Lam Research, Huntington Ingalls, KLA Tencor, and Microchip. All these earned an A- or better grade. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Thermo Fisher, Applied Materials, and West Pharmaceutical. These earned an A- or better grade. The companies with the best combination of recent dividend increases and potential of future dividend increases are Thermo Fisher, Lam Research, Applied Materials, and KLA Tencor. Here are trade confirmations from last Monday for the dividend growth stock portfolio. We took the weekly deposit plus any dividends that have been received recently and then reinvested the total in the top 10 stocks on our buy list from the previous slides. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those of you that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's return. 1, each week we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks and positions, in other words, ranked 1 through 5, outperform the stocks and positions ranked 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks and positions 1 through 5. In other words, buy the highest 5 ranked stocks, or maybe the highest 4 or the highest 6, whatever you want. However, the downside is this reduces portfolio diversification. But some investors are comfortable with a more concentrated portfolio. So far, investing in only stocks ranked 1 through 5 would have improved annual returns 76.3%. But I personally prefer a more diversified portfolio, since the goal of my dividend portfolio is to live off the dividends. And the more diversified it is, the less fluctuation you get in those dividends. Option number 2, don't limit individual portfolio holdings to 4% of the portfolio's total value. Normally, if a stock's allocation in the portfolio is 4% or greater, I won't purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio doesn't become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified, because the ultimate goal of dividend investing is to have the dividends cover all of your expenses, plus generate extra income for vacation, travels, etc. Now, I'm a conservative investor, and I'm personally investing a lot in these dividend portfolios, so I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind having a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is ranked in the top 5 of that week's rankings, as mentioned in the first bullet point. So far, not limiting individual stock positions to 4% of the portfolio would have improved annual returns by 48.5%. But again, I personally prefer a more diversified portfolio. Number 3. The under-the-radar dividend payers, despite having some incredible performers like F&G annuities, 119% gain in 12 months, and Repositrax 97% gain in the same time frame, on average, they have not performed quite as well as the dividend growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks have not done quite as well as the dividend growers is because many of the under-the-radar dividend stocks are very small companies, and small stocks have not performed as well as large stocks in recent years. Like the previous strategies, this method reduces portfolio diversification. So, number 4 comes in handy if you have a different way to evaluate companies for valuation wise, like is it expensive or is it cheap, etc. So number 4, sell when a stock is fairly valued, even if dividend and quality metrics are excellent. Now, we don't sell often in the portfolio, definitely not weekly, and tend to only sell if the company cuts a dividend or the stock appears to be overvalued, or the company's dividend and quality metrics fall out of the top 50% of companies. In other words, if a stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and that methodology signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting that week's top 10 stocks that we are buying. The downside would be higher turnover, but this could boost your portfolio's returns by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this 4th strategy is the most difficult to implement because you have to implement your own valuation methodology. But some people use a simple one like just looking at PE ratios. And for those looking for a less hands-on approach, let's think about some ways to potentially simplify things. Now, for model portfolios, we invest weekly, but there is no hard and set rule that says to do that. Most people in their real life invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually every other week, and it's automatically invested in their 401k. When I started our dividend growth strategy, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week as opposed to every other week or monthly is you get more diversification. So if one doesn't mind less diversification in their portfolio, option 1 is invest every other week or monthly instead of weekly. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. Over time, some will turn out to be clunkers, but they will just be very small parts of your portfolio as you let your winners run. On this slide, we're looking at our stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher's salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Now, MasterCard was the latest portfolio holding to increase its dividend as it announced another substantial dividend increase, this time by 15.2%. We should start seeing even more dividend increases when earnings season kicks off starting in January 15th. So over the next month and a half, we should see a lot more. Now, the last 22 dividend increases for the portfolio have an average of 10.1%. Now let's talk quickly about stock splits. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we receive once the stock split has occurred. Here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. American Express moves to the top spot with three of the first 4 slots going to credit card companies. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock, but I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's return would likely be higher if we'd always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated, more volatile portfolio. And many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. And people don't really understand their risk tolerance until they are in a severe bear market. Our portfolio holdings are now at 105, with 89% of the weighting being in the high-quality dividend-growing stocks, and 11% of the portfolio's weight being in the under-the-radar dividend-payers. We usually make far more additional investments into the dividend-growers than the under-the-radar dividend-payers. So far, around 100 to 105 stocks seems to be the natural limit for the portfolio, as there are only so many quality dividend-paying companies that are trading at a discount. That might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. The thing that did take a long time was creating the spreadsheet. It was pretty complicated. Now let's talk about our high-yield dividend-paying stock portfolio. I've had several older students who are closer to retirement take my classes. They're more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. The portfolio as a whole has an annual total return of 23.33% so far. Since the portfolio has been in existence for 60 months, that return will likely fluctuate a lot more than the return of our dividend growth portfolio, which was started 20 months earlier. Currently, the high yield portfolio's dividend yield is 4.37%, assuming you bought all the companies today. But the companies in it likely won't grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be best geared towards investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, and we've been able to sell some stocks at a high price and reinvest into better bargains, pushing the portfolio's yield based on the amount we've invested to 5.10%. Now, two strategies are being implemented in this portfolio, as you see in the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividends, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, that being both high yield and dividend growth. Strategy 2 has been the better performer so far. The average investment in Strategy 2 has provided a total return of 15.82% and has been held for an average of 197.2 days so far, which is an annualized return of 31.27% using Excel's rate function. Now, it's not likely that the portfolio can keep up a high annual return like that, since stocks historically average 9 to 10% per year. But so far, so good. Now let's talk about the high yield dividend paying stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday, and then we purchased the 8 stocks. And because the high yield stock portfolio currently has less than 0.5% in tech stocks, for those that want to add diversification to this portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which one is my favorite. Of course, the technology-focused investments with the higher yields do not have the chance to grow their distribution yields as fast as investment like Microsoft or Broadcom. There's always a trade-off, so don't chase yield. One thing that's different about this higher yield strategy versus our dividend growth strategy in the previous slides is we only purchase 8 stocks and we have 2 different strategies. As mentioned before, strategy 1 emphasizes a high dividend yield over dividend growth. That's perfect for investors in retirement or getting close. And strategy 2, down here in green, still emphasizes high dividend yield but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Now, having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2 at the same time. If that's the case, which happens frequently, instead of the stock getting a 1/8 weighting, they get 2/8, which is 1/4, equivalent to 25% of that week's investment. Both strategies still only invest in high-quality stocks, meaning a quality rating of B- or better. The 4 high-yield stocks we bought last week while implementing strategy 1 are Bristol-Myers, CVS Health, Enterprise Products Partners, and UPS. And the 4 high-yield stocks we bought last week while implementing strategy 2 are PepsiCo, American Tower, which is new to the portfolio, PNC Financial, and UPS. Last week's purchases have an average of 4.7% for dividend yield, with Enterprise Products coming in the highest with a 6.8% dividend yield. And here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. In the last column, you can see their grades for dividend growth potential, which will be much lower on average than the stocks in our dividend growth portfolio, which consist of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts, like Broadcom and Home Depot. Here are our trade confirmations from last Monday for the high yield stock portfolio. We took the weekly deposit plus any dividends that had recently been received, plus the proceeds from the sale of Entergy Corporation, and then invested the total funds in the 8 stocks that were on the buy list on the previous 3 slides. Now let's talk about our 2 technology-related stock portfolios. Because my students love technology stocks as well as crypto and options, we started 2 technology-related portfolios just for fun. For this first one, on January 1st of 2024, so we're just a little over a year in it, I funded a Fidelity account with $1,000, and we invested it into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this portfolio. We're sticking with the original $1,000 investment and seeing how high we can get it to run. The tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. This portfolio can invest in sectors outside of the technology sector as long as the company is connected to one or more of our tech themes. For example, both Meta platforms and Google are in the portfolio, but both are in the communication sector, not the technology sector. So far, the portfolio has gained 41.2% in a little over 12 months. In comparison, the most actively traded diversified technology ETF, ticker symbol XLK, is up 23.1%, and the S&P 500 is up 25.7%. The best performers in the portfolio so far are NVIDIA, which has tripled with a 200% increase, Broadcom 116.1%, Pure Storage, Meta, Fortinet, SAP, and ServiceNow. Now let's talk about the tech stocks we bought last Monday for our pure technology portfolio. I posted these rankings to our website, beatthestockmarket.com, last Monday. Then we purchased the top 10 stocks. Now on the site, we'll be listing the top 15, but we only have room for 10 here. So back in late April of 2024, so last year, we started a portfolio that only invests in stocks that are officially in the technology sector. Like most of our other portfolios, we invest weekly and then boost that investment annually by the rate of inflation. I hesitate to call this a portfolio since it's limited to only one sector, but it's sure been fun to follow. Since this portfolio started, it has easily outperformed the two dividend portfolios over the same time period. This tech stock portfolio, like I said, can now be found on our website. Over the Christmas break, I had time to put it on there. We only have room on this slide, as I mentioned, to show our 10 highest rated tech stocks as of last Monday, but on our website each Monday we'll post the top 15, not just the top 10, as well as a breakout of their quality metrics in case you want to only invest in the companies with the top management or the top financial health grades, etc. We also post the complete portfolio holdings and all of our past trade confirmations. Now this portfolio, even though the return has been the highest, has been very volatile, once again showing the advantage of lower volatility strategies such as the dividend investing for those who cannot stomach such large swings up and down. Now some people can handle the volatile swings, so just make sure you pick an investment strategy that you are comfortable with. So how is this portfolio different from the $1,000 tech portfolio shown on the previous slide? The portfolio on the previous slide is based on certain technology themes and therefore includes some stocks that are not technically in the tech sector, like Google and Amazon. So on this slide, I rate the top stocks for the week, but they must be in the technology sector. The average investment so far has been held for 118.7 days and has produced an average total return of 10.6%. Using Excel's rate function, that's a 34.37% annualized return. If we'd instead invested our weekly investment into the most actively traded diversified technology ETF, ticker symbol XLK, instead of a 10.6% average, we'd get only a 5.62% average, which is an annualized rate of 18.31%. And if we instead invest in the S&P 500, instead of that 10.67% return, we get 6.03%, which is 19.72% annualized. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. And also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend-growth stocks, because many tech stocks do not pay dividends, even though about 70 to 80% of the ones in this portfolio do pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, and other dividend metrics. But we use the valuation methodology we discuss in Classic, and we use it on all large stocks, whether they pay a dividend or not. So our 4 top-rated tech stocks last week were Adobe, Lam Research, Applied Materials, and Synopsys. So that's it for this week. So in the comments, let me know if you have any questions. Also, let me know what other kind of investing videos you would like to see. Also, if you're a subscriber, you'd like to see the tech-themed portfolio on our website, let me know. Remember, we put the pure tech stock portfolio on the website. And finally, here are the places you can reach me, YouTube, obviously, as well as my website, beatthestockmarket.com, LinkedIn, and Twitter. Remember, you can now find 3 of the portfolios in this video on our website, beatthestockmarket.com, with real-time transaction data on Mondays when we make our weekly investments, and anytime we sell a stock, as well as information about portfolio holdings and confirmations. The portfolios are the tech stock portfolio, the dividend growth portfolio, and the high yield stock portfolio. I'll see you again next weekend with a list of stocks we will have purchased on Monday. Again, Happy New Year and see ya.